Hey guys, I'm super excited to have Josh McCallen on July's edition of the SIH Capital Group monthly webinar series. As you guys know, I really try to focus on quality versus quantity. So when it comes to actual resort investment, I think there's no one, I think, in the space that's better known for it as Josh. I've known Josh since 2018, and it's been an amazing journey to follow along with him. Since I remember going to Renault while it was under renovation and walking through it, where my wife at that time was pregnant with our second kid, and we put a hard hat on my
Oh yeah.
wife's belly there, and we have amazing pictures. But I also remember Josh as someone who was really excited about his first major project on his own. And I've to see Josh then and now to see Josh now, where he produces these amazing resorts. And if you've never been to them, it's almost like the ninth wonder of the New Jersey thing. No, it's absolutely amazing. For people who don't understand, Josh has taken places where you wouldn't consider as a tourist attraction, like Egg Harbor in New Jersey, and he's made it into something that attracts people from an hour 2 hour drive that come around just to go see his properties. They're absolutely amazing. They're an experience, and he's got the model down. And so for anybody who's looking to diversify into hospitalities, we're going to have a conversation with Josh on why that's a good fit. That might be a good fit for investors. For some people it is not a good fit. I like it. I'm an investor with Josh. He has a long-term minded approach. And without ado, I just wanted to introduce Josh. How'd you get started in this? I know a little bit of your background story, but we'll keep it
Sure.
pretty quick, and then we'll kind of get into hospitality investing.
So I'm humbled by your intro, Dennis. Thank you so much, buddy. Yeah, that picture of your wife pregnant at the one of our earliest events for investors called Learning Grows was awesome. So this year we'll add our fifth really special property to the portfolio of properties. Accountable Equity is the group that helps us buy them. It's a bunch of accredited investors like yourself. And then we operate them as Viva May, which is French for Revive the Soul. And what we're basically doing is, see, we're starting a little opposite from what you might think I'm about to say. So a lot of people say, well, the numbers work out, we should get into this space. For us, we knew we were born to be in this space. We had done it for a family office, had built a famous coastal brand for them of hotels and resorts as the president. And then we got to have liquidity and buy our first one with partners, which was a Renault winery resort. But what happened during those years of being an investor with that family office, I realized this is what we were born to do, which is to deliver a certain type of hospitality based in the dignity of the person and loving the guest. So for us, really, the whole activity begins with, how can we infuse this three souls, we say, revive the soul. We like to tell the story of the soul of the property. So we tend to like historic things that are tarnished so that we can revive the story and the soul. Then we love the guest. And we want to make sure that when they get there and leave, they have a remarkable surprise, whether it be they were treated greatly, they had great product, food, whatever, but they just felt something special about the experience. And maybe they felt better about themselves even because they felt appreciated. And then the last, we actually don't put this last, but it's the teammates. And whenever you do a show like this or an interview like this, you say, you know, are we hypocrites? We're trying so hard to be great at all three revivals of souls, but it's challenging as heck to motivate staff, and we're not perfect, right? And so I hope we're doing above average on treating our guests, our staff, our team like our staff, like our guests. And we think we are, because we're driven entrepreneurs. So sometimes people might perceive one thing as kindness and and take it as weakness. So that's a whole challenge in and of itself. But for us, the investment thesis comes from the actual core operation of a hospitality product. And good news is for you and I, Dennis, because I know you're buying some hospitality products. Hospitality, operating resorts, operating real estate like that can be some of the most lucrative for investors. And I should probably come up with like the top three reasons why it's lucrative, but I'll do one on the fly because I think you'll like this. For us, the first one is there's tremendous tax strategy when you buy a resort real estate piece. You thought I was going to say good high cash flow. I That is tremendous. I'll say that too. But number one, we're going to buy something that's a big gigantic piece of real estate with a lot of little equipment and buildings, and we're going to do a cost seg, and they're going to get a super powerful depreciable event early in the hold period. And then we're not flippers. So technically, they could have a very long benefit of not having those recaptured taxes. So that's one massive surprise when you buy resorts. It's a higher level of depreciation than a multifamily because of all the other operating equipments. Two is it's a lot of cash flow. The best way for a single family investor to understand this is the difference between renting your house out for 2 years at a time or Airbnb it successfully. They'll see so much more cash flow if they Airbnb. Bankers tend to like the long-term hold strategy of a lease, but cash flow is the renter, the Airbnb rent. Well, in resorts, it's similar. And because it's so much extra cash flow compared to multifamily, let's say, that is the third thing. It's safer. And I know you and I were talking about this ahead of time. How can buying a resort be safer than a multifamily? And I think you have a lot to say about that, but that might be where we dig in for the rest of the show.
Yeah, and I also bring up the interesting part about your number two that's on the fly is that a lot of investors who in the last 3, 4 years are like, oh, I want to buy an Airbnb or Airbnb. Airbnb is equivalent to buying a single family rental. When you buy a hospitality, that's like buying a multifamily property because now you get all of that scale that you would see in multifamily. You get it because if you have one Airbnb, you still need a cleaning lady. You still need to coordinate cleaning schedules. You still need to do all of that. However, when you have a hotel, it's a completely different level of scale, but it's the same thing. You still need to coordinate a cleaning scale, all of that stuff. So I think that's such an amazing point that you made. And I know from my experience, the one really interesting part is if you do one single Airbnb, you can't really build a brand. There's no real feel to it. However, once you get into the scale, the Airbnbs or a hotel or a property, now you could have that brand, you could have that goodwill, and it translates to all of your different properties. So I think that's such an amazing point, Josh, that you brought up that you just don't see that when people compare, well, shouldn't I just do a single family Airbnb or should I invest in a larger scale hospitality? There's no comparison at that point.
And to keep in mind, the other thing I say to passive investors that want to join us, you're going to get outsized returns when you join us, but I'm always super honest and straightforward. But you would make more money if you bought your own batch of houses. Why? Because think about it. We've taken a big piece of real estate and made it available to hundreds of investors, and everyone's striving for that double digits plus tax strategy plus cash flow forever plus enjoyment in our case, right? You get to go visit your beautiful asset. But if you were to just start flipping houses, by far you might be able to make more. You might lose more, but you're probably going to make more pound for pound, but it's active business, right? So people have to, in their minds, recognize that as soon as you stop wanting to be active in investing, like that Airbnb model you just said, look, a great investor who buys one Airbnb and drives the ship every day with their text messaging and some little bit of ads and a little bit of could drive more profitability off that investment. Here, it's a total hands-off model. You get to enjoy. And some people really like it. We have a lot of repeat investors and they just use their resorts because they're all in relative driving distance. They'll just go to them. I don't know they're there. The staff don't necessarily know they're coming, but it's all the time. It's golfing. People go golfing. People go to the winery. People go to the ice rink program we have in the winter. They'll rent fire pits. And that's been a real fun surprise for us over the years. I call it's as if the ownership mindset, because who's the best salesperson of a real estate property? The owner. And who's the second best? All the owners. You know what I mean? It's like we have owners on top of owners telling people how great it is. And I couldn't have predicted how powerful that would be for the business.
Yeah, like from a capital raising perspective, I've always had the best experience when I've gotten investors to the property.
Yep.
And part of that strategy I got is I see it from you and the Learn and Grow event. You see that connection that is built when quarter by quarter you can get them to that property. It's a whole different story. There is a legitimate connection versus, oh, there's a multifamily in Texas, and you're like, well, I'm not gonna fly out to Texas to go touch an apartment building. It's an apartment building. However, to go to, the oldest, second oldest winery in the country, that's a cool experience, and that's something you could bring your wife to. Versus like,
Yep.
hey, let's fly down to Texas to go see this apartment building. That's going to be a hard sell at that point.
It is. It is. And since you brought up the beautiful Renault Winery Resort, which I'm sitting in front of the picture of it, but that property just keeps getting better. We're marching towards, we've already, I would at least a 10x valuation increase since acquisition. But I don't think it's even done growing. And this year we'll add a spa experience, more suite rooms, and we'll just capture one of our strategies in resorts is we like to capture the downstream profits from the upstream work we're doing. So in our case, we're one of the biggest wedding operators in the world. At all the properties together, we're definitely measurable for the whole world. But even at Renault, in and of itself, it might be one of the single biggest wedding sites because it can do so many at once. But the brides, the families, they want us to provide more amenities and they will pay for it. So adding this spa, it almost has a built-in client basis because we already have next year's wedding sold and some of 2026. So as we open the spa in late 24, it'll have almost like a pipeline built right in rather than just launching a brand new business because it's a complement to the weddings. And it'll be fun for you and your wife to come down to too.
Yeah.
We'll have all kinds of new amenity packages with that. And that's why it's currently available to invest in because right now we're capitalizing another phase of this exciting project.
And Josh, one of the things I do love about your organization, your vision, it's a very similar vision to what we do, where it's like a slow and steady. And I didn't know when I was starting out that that's going to be the case. I think I was just a little choosy on some of my investments and partnerships, but it ended up being where we ended up acquiring one or two deals. And I know we talked about this briefly. Since I've known you in 2018, you guys are not one of those operators. And I actually warn against some of those operators to my investors where you went from three deals to 100 deals or whatever it is. The problem is people forget that real estate investing is also a business. Every property you buy is its own different business. And if you try to buy 20 businesses in one shot, it's gonna not end well. So one of the things that I do truly respect about your team is that you guys have been very methodical. Like every single year, you identified a beautiful historical resort, and I know for every one deal you've done, there's probably 10, 15 that you've offered on and gone through due diligence. Can you shed some light on now that you're in it 6, 7 years? You guys have, I think, your fifth property coming up. Just
Right.
some light of being able to only acquire 5 deals in 7 years. What has that allowed your team to actually do?
Well, Dennis, I think you have probably just because we've spent some time together, you have picked up on a lot of the key principles. And one of them is we have been trying to buy properties and we probably have done a little bit extra due diligence more than we should have, probably on about 20 to 25. And they usually have been in strategic locations and or a strategic opportunity, meaning the sellers wanted us to buy them. And so that's usually a really good indicator that we're probably going to get a deal done is the more interest the seller has in us and we have in them. So we have a certain niche we're doing right now, which is the historic lifetime assets that are unrepeatable. Yes, you know how you just said Renault is the second oldest winery? You're right. Technically, there's one that beats us by 4 years up in upstate New York, but nobody has more historic incidences and inner overlays with American history than Renault. You got the Prohibition history, and you have the Champagne bubbly wine history, and you have the Miss America pageant. We were one of the first sponsors, and the Johnny Carson spokesman when he was a rookie. So I would say we came up with a new moniker. No longer do we say we're the second oldest winery. We just say fact. We are America's most historic winery. because I don't know how you can top it, right? There's just so many cool stories connected to this property. But yeah, no, you're right. We've been methodical. What we tend to look for is motivated sellers that want to hold some paper and have an asset that they did not optimize, which is basic real estate, right? But it was big. And because it was big, it pushes out every mom and pop who wants to be the buyer of that challenging property. And so we have specialized in this kind of the challenge above the mom and pop, way too many steps for the institution. And so we're below the institution and we're way above the mom and pop. And so we do think we have a lot of opportunity right now, to be honest with you. And that's why we're buying one a year right now. And the last few things we're buying, we like two geographies, drivable distance from New York for a getaway experience or a wedding or a corporate offsite, those three core markets. And then we like DC drivable. Within those two markets, New York and DC, this is the two of the three most lucrative wedding markets in the world. And so as long as we are super good looking and we do the right advertising, we will get their calls. And when we get their calls, it's up to us to do a quality sales process and fill these beautiful properties.
I love that model. Josh, let's talk a little bit more of why it's critical with seller financing these days. I think we briefly shed light on it. So one ironic part is if you looked at any of the headlines and why commercial real estate is in trouble, usually those headlines are very national or office building in San Francisco went foreclosure, so everybody's in trouble type of thing. But the truth is, the industry today, the deals that are in trouble are the ones that were bought with bridge loan or variable interest rate financing. Your situation is completely different. Since I've known you in 2018, banks never really liked the hospitality space. So I think it's forced you guys to adapt back then, which now has led you to not have the same issues. Like I've never seen you do a bridge loan or variable debt type of thing. Most of the time it's seller financing. Now I feel like you guys are in a much stronger position than a lot of the traditional multifamily deals. Can you shed some light on how that kind of evolved and where you guys are and where you see the, I guess, the appetite for bank financing to be in 5 to 10 years?
Okay, so this is a happy accident that when we were getting into this, there was actually pretty viable traditional bank debt available to a stabilized resort business. And I had just done with my previous partnerships, we had just done a big, gigantic refinance, and banks loved us. Two things were different when we got to Renault. It was an underperforming, not very much performing at all, and had bankruptcy on its record because at the time I bought it from a bank. So those elements, plus the fact that we had physical rehab to do and business operational turnaround, made it impossible to get traditional banking. And that'll be like that in any market, I think, Dennis. So that one we knew eyes wide open, this isn't going to work for a while. Maybe we thought 3 years, and then 3 years came due right during the COVID. So clearly the 3-year goal of trying to get a normal bank didn't work. But the hold period was always supposed to be infinite or indefinite, I should say, long term. So what that taught us is we used traditional construction structures, which are more expensive and are based on capital improvements. So that's the model we used at Renault, which means our double-digit interest rate was part of our pro forma. And honestly, in hindsight, that's why we've kind of had success through these difficult financing times now, because it's always been tough for us. It's almost like you work on your muscles and they get stronger. So yes, we are grateful that we've always had a high interest rate environment in our type of hospitality. And when the economy when we mature as a company, and when the economy matures, we're going to be able to get really favorable refinance structures. And that's going to be a nice surprise, nice positive for the investors. And you know what else is going to help us be very attractive to banks as the economy stabilizes at whatever interest rates, 26 are going to be, whatever, is portfolio building. So banks do appreciate a portfolio. Maybe we'll get offers to do a really attractive package for all of them, or we'll have just the brand promise spread across a portfolio. Will actually improve our cap rate when being analyzed by appraisers and or investors. They will benefit us with a lower cap rate. But those are some interesting things. I don't know how deep you want to go into all that.
No, I think that that's the interesting part about it is how different it is from multifamily, where you guys started as a disadvantage, and I think that's becoming your advantage. I also think from an acquisition side, it has fine-tuned your check boxes where
Absolutely.
you can't just go in and say, "Oh, I'm just gonna buy this 80% LTV," right? It's like the conversation has to kind of almost go quicker than you usual. Like seller financing is a touchy negotiation piece, right?
It
It's
can. Yeah.
it sometimes is make or break. Usually it's make or break for these kind of deals. And if it's brought up too early, it can ruin the relationship quickly. You kind of want to have a little bit of a relationship before really approaching that subject. So let's talk a little bit about that because I know your last deal. I'm not sure about the Blue Elk Winery. I know the previous one, Bohemian. You guys had some kind of seller financing. So just if you could briefly mention how seller
Yeah.
financing kind of evolved for your company.
Well, so what was nice about seller financing for us is we saw it. Yeah, it in sales you're the salesperson when you're the buyer selling your group to the seller, in my opinion. And in sales, one principle we get scared about if we ever hear our salespeople not convinced in their own product. I know that that will translate to every buyer, right? So if it's a problem in the buyer's mind or seller's mind, if it's a problem in the seller's mind, it'll be a problem in the buyer's mind. So in reverse, when we go into a negotiation, when we talk to a family that owns something, we always say, we believe we are your buyer. So one, we want to get on their side of the table. We want to help make this a solution. And I always say the great news is we're not bottom feeders. And that's my first, second line. We're not here to beat you up on price because we're gonna analyze it. And we're gonna give you the exact price that the cap rate and what the market says. So we're not gonna go below that. And then because this property needs a turnaround, we'll keep you in the deal and you'll be able to get your highest dollar possible because you get to work with a company like ours and we'll be paying you out over time. So we just make it like that's obvious how you're gonna want to do this. Why? And then I say, because the other option that is viable today too is you could go ahead and take a cash offer, but I think you understand they'll probably ask you for about half your retail price. So, if you help set them up, it's like anything. It's like wholesaling. If you want an all cash offer, they're going to give you what, 50 cents on the dollar for the property, which allows the flipper to make room on that property. Well, it's the same thing in these. So from our point of view, that's our strategy. We do a couple other things though, Dennis, and grateful this has worked out. We encourage, we actually also we go one step further, and I'm not the best negotiator, but we say to them, we will be getting bank debt or some structure of debt in first position. And as I mentioned, to get you maximum proceeds on the sale for you, Mr. or Mrs. Owner, what we're going to do is structure you as a primary equity holder where you're on the equity side so that it doesn't cause the lien holder, the bank, any challenge on you getting the maximum price you want. So what we've done once, and we haven't done it since then. Darn it. I wish we were, but it's the ultimate way to do it is you give them collateral in the GP entity. And so the GP won't be able to distribute to the limiteds until we pay off this landholder. But it's the same thing as a second lien position. It's like they're in second lien, but they're not touching the real estate. And so that they may balk at first, but if you can just close that, then you'll always be able to put a first position bank loan on your property. And they might have to wait around, but truthfully, they will be way ahead of all your LPs. They will get their money.
Like a pref equity type of status
Yeah.
structure. Very cool.
That is the holy grail. So we should all get better at that. And I've done it once, and it went really well. I don't know why. The second two times we had to go to second lien position, which is the only hiccup we're having in our current acquisition. Is the seller is just frustrated by that, because it has language in there that prefers the first lender, obviously, or else it wouldn't be called second position.
It's their attorney has an issue with that, right? That's the issue. Usually the seller, if they trust you, they're okay with whatever is in the paperwork. The attorneys then become an issue. And then
Right.
that's the person, and especially if it's slightly unconventional, the attorneys don't understand that the hospitality industry has a very different market price for this. So they're just saying like, well, if this was market, why do we need to get creative with these terms? And then I've had this hundreds of times with acquisitions. It's one of the most frustrating things you can go through because honestly, you go into it trying to make it a win-win. We're working on an acquisition right now. He named the price, and I said we will do whatever we can to get you that price. But work with us on A, B, and C. The last thing we need is an attorney to come in and say, well, A, B, and C is unusual, and then walk you against it because now it puts you in a position to go back on the price. So it is. I think we have a very similar approach when it comes to that. Josh, I know we're short on time, and I want to be respectful of your time, but I did want to introduce my investors to the Accountable Equity Group. I love introducing my investors to operators that have a long-term perspective. You are not looking for a 3-year deal to get out because, quite frankly, these historical assets are just too much work to sell them after 3 years of putting your heart and soul into them, right? So I'm more than happy to introduce you guys. Josh, where can our investors, learn more? Maybe even go to a Learn and Grow event. I know you guys have them quarterly.
Oh, yeah. So these Learn and Grow events, which I think you'll be at the next one in August. August 24th is a Saturday, and it's an all-day event. We subsidize most of the cost, so it's a nominal cost. You end up meeting all accredited investors. And what we're doing with these is accountable equity is the way we raise capital. And we say our name is our mission. We get it. As soon as your family invests with us, the amount of positive stress we feel it's hard to measure. So we always say it's right out in the open. We're accountable. We get it. And we want you to maybe take some responsibility to be accountable with your own stewarding of your own goodwill and your investments, even beyond what you've put in with us and your family and your work and your other investments. So this is really a holistic type of event. Yes, we get to see beautiful properties. Yes, there are some opportunities to invest. But the main part of it is immersive experiences where you bond as a community. So chef experiences, meals, great presenters all over. We're flying people in from all over the country. We got the head of Directed IRA, one of the fastest growing private IRA groups. Oh man, the best. Matt Sorensen, he's famous. He'll be speaking. And then we have the world-class tax strategist that's going to teach you billionaire style tax strategy, which to him is going to be, he's going to explain it in common English, and it's going to change your family's wealth trajectory, whoever's listening now, because you're just going to do the same strategies that the wealthiest families do. But guess what? They never taught you and I. And so now you're going to the door's going to be open for you. So we really look forward to meeting you. It's accountableequity.com.
Josh, thank you so much for being on. Enjoy the rest of your weekend, and we'll be seeing each other in August.
See you, buddy.